Okay, let's get to our lines in the sand real fast again so we're all very clear on what we're doing here. Thursday, Friday, before options, monthly options expire, we often hit pivotal lows in the market. We talked about that here. Below that level, I would be bearish. We talked about this level here. And below this level, which is on our daily update 27.22, I would be relatively neutral because I would expect the market to be very sloppy. These levels right here, which is 27.85, I certainly would be probably less than 50% long because this whole breakout would be negated. So I would say I would be bearish, neutral, and building cash right here. This 50 SMA where it is right now, so let's call it these old highs. I think that's pretty critical. Let's call it 28.50. Right now, for any new trades I put on, I would say the ultimate line in the sand, if they're swing trades, would be as if the S&P broke 28.50. If it broke 28.50, it's be breaking a rising 50 SMA, breaking below this old resistance, which should have been support, and that's where the market would, like I said, could have further deterioration. So we already have an idea of what we want to do if the market turns south. If the market stays in this trading range, what do we want to do? Well, we want to increase our long market exposure, right? But don't expect a lot of upside in the short term. You know, you could sell covered calls against your positions. If you own the spiders, the QQQs, you can sell June calls. Sell out of the money. Sell slightly out of the money calls. QQQ, UDOT, whatever it is. Make some money on selling premium. So that's the way you can do it. But use the buying opportunities like we saw all week long on ES. And this was just unbelievable, the opportunities we saw here. 5-2. Wish I could show more days. Let's see here. Time frame. 5 days. Okay. So we don't have time to dissect them, but we dissected them during the day, and you see these breaking these downtrend lines, and the market just roars. And you have your stops in place when you get there. When you have the MACD that confirms these V bottom lows, and we're just grinding higher. And once again, I would imagine we're probably going to try to get stops up above this 29.50 area before we head back down and then retest maybe 29.20. I think that makes the most sense. Go get the stops first, and whether that happens Friday, Monday, or whatever, and then revisit maybe 28.20. Let's just call it 29.10 to 29.20. And that would be a higher low. And then you'd look for a higher high. And that pattern is the most likely pattern that's going to happen over the next week or so. So you know exactly what I'm looking for. You know all my positions, all my entries, all my scales, all my stops. You have my analog, the historical chart pattern comparison that we're using. You know my take on the market. The only thing we haven't looked at yet before we look at the rest of the stocks is our weekly time, which is our higher time frame, right? And the MACD is almost the highest it's been since March 18, and that's bullish. And you can see as long as we stay above this green line, we stay in an uptrend. So this looks phenomenal. Now, the only thing I guess you could say is we're hitting new highs without MACD at new highs. If that's really the only card you have, the only hand you have that's bearish, that's not a lot. We've talked about this over and over again, that bearish divergence doesn't mean anything until you get knocked out of trend. And it doesn't necessarily mean something then. We just saw the market hit new highs without MACD, and what did it do? It got knocked out of trend and came right back in because we have rising moving averages, and the higher time frame is still in charge, which remains bullish.